As artificial intelligence just keeps demanding more and more data, more energy, the actual physical hardware holding everything together is, well, it's starting to strain.
It really is. We're hitting fundamental limits, especially in how efficiently light and electricity can work together inside the machines.
Exactly. But what if there's uh, this relatively small company out there that's found a potentially fundamental shift in how that connection works, something that could maybe unlock the next stage of AI?
It's a fascinating prospect, and it sets up this high-stakes situation we're seeing. Huge challenges, no doubt about it,
Right.
but also this potential upside. Some models are suggesting the current share price might be, well, significantly discounted compared to its long-term theoretical value.
So we're going to dive into what that could mean for you, especially if you're trying to track where innovation might lead to some, let's say, outsized opportunities. Welcome to the deep dive. Today we're tackling a complex one, POET Technologies, Inc. That's NASDAQ Q, ticker POET. We've gone through a pile of research financials, industry reports, analyses, everything current as of August 17th, 2025. POET closed at $5.04 share then.
Mm-hmm.
Our mission today: cut through the noise, pull out the really important stuff, and help you get a handle on this company's story, the good, the bad, and the potential.
And what's really compelling, as you said, is that dichotomy. It's striking. You look at the numbers, pure financials, and you see, frankly, significant hurdles and risks, big ones.
Definitely.
But then you connect that to the underlying tech where they sit in the market. And suddenly you've got this story of, well, audacious ambition. And that potential upside we mentioned, analysts and some models are starting to really highlight it. We're going to unpack why both sides of that coin are true.
Okay, let's get into it. We'll begin with Chapter 1, Business Analysis. So POET Technologies, they run on what's called a fab-light model.
Right. fab-light.
Which basically means they intentionally don't own the huge multi-billion-dollar factories, the fabs, that actually make the chips.
Smart move, really. Necessary, even.
Yeah, seems strategic. Their focus is all on the design, the R&D, the intellectual property, the brains behind it, and they outsource the actual manufacturing to partners who specialize in that.
Which you almost have to do in this industry, unless you have incredibly deep pockets. The capital required is just immense.
So their revenue streams, they're pretty small right now, but they're structured in three ways. First up, product sales.
The long-term goal.
Exactly. This is what they hope becomes the main thing. Selling these high-speed optical engines, light sources, the critical bits needed for AI and data centers.
The hardware that makes it all run.
Then there's non-recurring engineering, or NRE. This brings in some near-term cash. It's basically custom design work for specific clients.
Like that Q2 2025 number you found.
Yeah, exactly. They reported $268,469 for NRE and product revenue combined in that quarter. It's not just about the money, though. These projects help prove their platform works and build those crucial customer relationships.
Validation is key at this stage.
And third, and this might be the biggest long-term play, technology licensing.
High margin potential there.
Definitely. The idea is to license their patented tech to other companies. If they can get others to adopt their platform, well, that's how you potentially become an industry standard.
And the core of all this, the real heart of their innovation, is the POET Optical Interposer.
Right.
It's their patented platform. The whole idea is to integrate electronics and photonics, light-based stuff, smoothly onto a single module. They call it the semiconductorization of photonics.
Semiconductorization sounds complex.
It is, but the concept is powerful. They're basically using standard high-volume chip manufacturing techniques, wafer-level stuff, to combine light and electricity together on the chip itself. Very different from how it's usually done.
Okay, and this interposer thing, it's the foundation for a whole lineup of products targeting that hunger for data speed, right?
Exactly, all built on that core tech.
You've got POET Teralight. That's their top-end 1.6 terabit per second optical engine. Cutting-edge stuff for the most intense data needs.
Which is just staggering speed. Think AI training, massive data flows.
Yeah, like streaming hundreds of thousands of HD movies at once, that kind of bandwidth. Then there's POET Wavelight and Infinity. These are the 800G and 400G engines. More for the current high-volume needs in AI clusters, big data centers.
The workhorses, so to speak.
Right. They also have POET Starlight and Lightbar. These are light source products, apparently critical for chip-to-chip communication inside dense servers.
Getting light onto the chips efficiently is a huge challenge.
And finally, the foundational stuff, POET Legacy and One. These are the 100G and 200G products that kind of prove the tech worked in the first place.
Built the foundation.
Now let's talk scale.
Yeah.
Or lack thereof, maybe. POET is a small-cap company trying to shake up a huge industry. As of mid-August 2025, market cap around $457 million. That ranks them, what was it, 769th globally.
Tiny, relatively speaking.
And here's the kicker. Trailing 12-month revenue, just $467,900.
Right. So that valuation, nearly $500 million on less than $500,000 in revenue. What does that mean?
Good question. What does it tell us?
It tells you the market is absolutely not valuing current performance. It can't be. That valuation is almost entirely a bet on the future. It's pricing in the hope, the potential, that this technology eventually grabs a meaningful slice of a very, very big market.
Purely speculative at this point, based on future promise.
Entirely. It's a forward-looking bet.
So, okay, why should you, the listener, care about this tech? Well, POET is trying to solve some big headaches in photonics. Currently, building optical modules is often slow, expensive, involves fiddly manual alignment of tiny parts.
Yeah, it's surprisingly manual in some ways. Very skilled labor, very costly.
POET wants to toss that out and replace it with automated wafer-level integration, like how regular computer chips are made.
And think about what that could mean if they pull it off.
No.
This isn't just a small improvement. This semiconductorization they talk about could totally change optical manufacturing.
Like moving from handcrafting to mass production.
Exactly. It promises drastically lower costs, the kind of scalability AI desperately needs, better performance, lower power use, things you just can't get easily with the old ways. It really could be a game changer if they can execute at volume.
Okay, let's shift gears slightly. Industry analysis. Where does POET actually play?
Well, they're in the global photonics market, and it's enormous, absolutely massive.
Why are we talking?
Estimates for 2025 alone are somewhere between $950 billion and maybe $1.75 trillion. It's a huge range, but massive either way, and it's growing fast. Forecasts suggest it could hit $1.6 trillion to maybe $2.4 trillion by the early 2030s.
Wow. What's the growth rate on that?
Looking at a compound annual growth rate, a CGR, of around 6.5% to almost 8%. Pretty robust.
And what's driving that growth?
It's being pushed by these huge megatrends that line up perfectly with what POET is trying to do. You've got the explosion in AI and cloud computing demanding insane data speeds. That's POET's sweet spot with the optical engine.
Makes sense.
Then there's the whole 5G network rollout globally, needing tons of optical links. Plus, growth in sensors, think Internet of Things, LiDAR for self-driving cars. These are powerful tailwinds for them.
Okay, sounds promising, but the competition.
Yeah.
The Goliaths.
Right. They're up against absolute giants. Broadcom, Intel, Lumentum, companies with, vast resources, established customer bases, huge R&D teams.
POET is definitely the small disruptor, the David in this scenario, trying to challenge these deeply entrenched players.
And it's not an easy industry to break into, is it?
Not at all. The barriers to entry are incredibly high. That protects the big guys, but makes it really tough for newcomers like POET.
Well, what kind of barriers are we talking about?
Well, first, just the sheer technological complexity. You need world-class engineers, strong patents. Then, even with their fab-light approach, their partners need billions invested in manufacturing facilities.
Right, someone has to build the stuff. Exactly. Supply chains are complex, often rigid, easily disrupted. There's a serious global shortage of talent in this specific field. And on top of all that, you've got regulatory hurdles, export controls like the U.S. Commerce Control List, complex supply chain compliance rules. It's a minefield.
So given all that, what are their actual competitive advantages? How do they even stand a chance?
Good question. Well, brand strength is tough for a small player, but getting awards like Best in AI or Best Optical AI Solution in 2024 helps a bit with visibility.
PR points, maybe.
Yeah, but the real validation, the crucial stuff, comes from their strategic partnerships. When companies like Foxconn Interconnect Technology, Luxshare Tech, Mitsubishi Electric, when these Tier 1 giants partner with you on next-gen products, that sends a powerful signal to the whole industry.
It says, okay, this tech isn't just smoke and mirrors.
Precisely. It signals credibility and viability from players who really know the market.
What about cost advantages? You mentioned that potential earlier.
Right now, they don't really have economies of scale. They're too small. But their entire investment thesis, their whole story, hinges on achieving that cost advantage in the future.
Oh.
Their core claim is that this wafer-level integration can slash the packaging and testing costs for optical transceivers, which can be like 70% of the total cost now, down to maybe under 20%.
That would be huge.
Absolutely profound if, and it's a big if, they can prove that consistently at high volume. That would be their killer competitive edge.
And their most defensible asset, what's truly unique.
That would be their unique asset, specifically the intellectual property, their patent portfolio.
How strong is it?
They have over 74 granted patents, plus about 12 pending. These protect the core innovations behind the optical interposer platform. That patent note is the legal bedrock supporting their claims of better performance and lower cost.
Okay, that makes sense. Let's shift focus now to the people running the show. Chapter 2, Management Evaluation.
All right. The executive team at POET, you have to say, looks pretty seasoned on paper.
Who are we talking about?
Well, the CEO is Dr. Suresh Venkatasan. He's got over 20 years in semiconductors, including a senior role at Global Foundries, a major chip manufacturer.
Okay, relevant experience.
Definitely. Then there's Thomas Mika, the CFO, decades in finance and executive roles in the semiconductor equipment sector. He was CEO and chairman of Tegel Corporation.
So he knows the manufacturing side too.
That seems like it. And Vivek Rajgaria, the president and GM. He brings about 30 years specifically in optical communications. He used to run a big business unit at Mecom, another key player in this space.
So deep experience across the board. That seems crucial for something this complex.
Absolutely essential. You need people who understand not just the tech, but the manufacturing, the market, the finances, especially to turn these advanced concepts into actual commercial products.
So with such an experienced team, why this ongoing issue of, well, funding operations through equity offerings? That dilution keeps coming up.
Yeah, it's a critical point, isn't it? It really underscores the fundamental challenge here. Even with a top-tier team, bringing truly cutting-edge, capital-intensive tech to market requires constant, significant cash inflow.
And they don't have much revenue yet.
Exactly. So for a company in that position, selling new shares, equity offerings often becomes the most viable, or maybe the only viable path to get the capital they need to keep going. It's a direct trade-off. Fund progress now, but dilute existing shareholders in the process.
Makes sense, even if it's painful for shareholders. How are they actually allocating that capital? What's the focus in capital allocation?
Pretty clear focus. Almost everything goes into R&D. They spent, what was it, $3.2 million just in Q2 2025. And SG&A, the selling, general, and administrative costs.
What about M&A? Any significant moves there?
Their history there is interesting, actually. They sold off Dense Light Semiconductors back in 2019. They'd acquired it earlier, but selling it marked a clear pivot towards this dedicated fab-light model. Shows focus.
Strategic shift.
Right. And more recently, late 2024, they bought the rest of their Chinese joint venture, SPX, Super Photonics Integrated Circuit, paid about $6.5 million for the remaining 24.8%.
Why do that?
Gives them full control in China, a key market, but it also supports this China plus one strategy everyone's talking about now, diversifying manufacturing, in their case, setting up capabilities in Malaysia as well, de-risking the supply chain.
Which brings us to the question of returning capital to shareholders.
Yeah, that's a quick discussion. As a development stage company burning cash, there's no history of dividends or buybacks and no plans for them either.
All hands on deck for growth and survival.
Exactly. Every dollar goes back into the business. And that's why, unsurprisingly, metrics like return on invested capital, ROIC, are deep in the red. TTM ROIC is negative 229.5%. Other profitability numbers are similarly negative.
Not about current returns at all.
No, it's purely a bet on the future potential payoff.
Okay, let's dig deeper into those financials. Chapter 3, Financial Analysis.
All right, let's recap the key metrics we've touched on. Small market cap, $457 million-ish. TTM revenue, tiny, just $467,900. And TTM earnings per share, EPS, is negative $0.81.
But that revenue growth trend, you mentioned it earlier, it's small numbers, but after basically zero revenue in 2020, that TTM figure is up over 300% year over year.
Right, 302.5% increase. It is from a minuscule base, absolutely. But it does signal something. Customers are actually starting to pay for their stuff, their NRE services. It's a tiny green shoot of market validation.
Still, the bottom line looks pretty grim for now.
Oh, absolutely. Because they're pre-commercial, really. The profit margins are, well, astronomical in the wrong direction. TTM net margin is minus 11,497%.
Wow. Just reflects the cash burn.
Exactly. And free cash flow follows suit. Consistently negative, and the burn is accelerating as they invest more. TTM free cash flow was negative $38.56 million.
Which is expected in this phase, right?
Yeah.
Heavy investment.
Totally expected. Same story with earnings. Consistently negative for more than a decade now, and the losses have been widening from about $17 million loss in 2020 to nearly $57 million loss in 2024. Shows you the scale of investment needed.
How about financial stability? Are they leveraged to the hilt?
Actually, no. Their debt-to-equity ratio is very low, only 13.2%. That's just $6.5 million in debt against almost $50 million in equity.
That sounds positive. Conservative on debt.
It is, but you have to remember how they achieve that. It's largely through what you might call solvency through dilution. They've been issuing shares to raise funds rather than taking on lots of debt.
Got it. And short-term liquidity.
Looks decent for now. Their current ratio is 1.89. Generally, anything over 1 suggests they have enough current assets to cover their short-term liabilities, so they seem liquid enough in the near term.
Okay, let's talk valuation analysis. How do you even value a company like this?
Well, traditional relative metrics are pretty much useless. Price to earnings, it's negative 6.22. Price to sales, over 11,000.
11,000.
Yeah, it's astronomical. But again, what does that tell you? It screams that the market is pricing in absolutely massive future growth. It's ignoring the S for now and betting entirely on future earnings and cash flow.
So you have to look at intrinsic value models like DCF.
Right, discounted cash flow. That's where you try to project future cash flows way out, make assumptions about growth and profitability, and then discount it all back to today's value.
Which sounds incredibly speculative for POET.
Highly speculative. The assumptions you have to make are heroic, frankly.
But you mentioned a model earlier.
Yes, there's at least one publicly available educational DCF model out there. And it's fascinating because it estimates an intrinsic value for POET of $11.46 per share.
Okay, $11.46 compared to the current $5.04.
Okay.
That suggests, what, 56% undervalued?
Roughly, yeah. And this is but you absolutely have to understand what's baked into that $11.46 number.
Aggressive assumptions.
Extremely aggressive. We're talking assumptions of future revenue growth hitting nearly 190% annually for several years straight. And it uses a very high discount rate, 25% or more.
Why so high on the discount rate?
To reflect the enormous risk, that high rate significantly lowers the present value of those future hopes. So yes, $11.46 is a potential intrinsic value, but it's built on a very optimistic, high-risk scenario actually playing out. It's a theoretical target, definitely not a guarantee.
Understood. So that's the fundamental picture.
Yeah.
But how is the wider market actually reacting? Let's get into Chapter 4. Market sentiment. What's the market perception? What are analysts saying?
Wall Street analysts, the ones covering it, are actually quite bullish. There's a strong buy consensus rating.
And price targets.
The average one-year target is $6.63. That's over 31% upside from that $5.04 price we noted. And the range between the high and low targets isn't enormous, suggesting some analyst agreement.
But the news flow seems mixed.
Very much a tale of two narratives. You see tons of positive press releases and news about the technology itself, the partnerships, Foxconn, Mitsubishi, those awards. All sounds great.
The potential story.
Exactly. But then the financial news is consistently negative. Headlines about missing revenue estimates, widening losses. The market seems, for now at least, to be weighing those positive catalysts, the tech and partnerships, more heavily than the current weak financials.
Interesting. What about other market indicators? Like short interest.
Yeah, despite the bullish analysts, there's significant bearishness too. Short interest is pretty high.
How high?
Let's see, 6,067,516 shares short. That's 7.21% of the public float. And importantly, that number has been increasing.
So more people are betting against it.
Seems that way. This sets it up as a classic battleground stock. Bulls versus bears, which usually means higher volatility.
And technically, moving averages.
From a technical standpoint, the picture looks negative right now. The stock price, $5.04, is trading below both its 50-day moving average, $5.26, and its 200-day moving average, $5.88.
And the longer-term average is above the shorter-term one.
Yep, the 200-day is above the 50-day. That's often seen as a classic technical sell signal, suggesting negative momentum, at least in the short to medium term.
Okay, so conflicting signals there. Bullish analysts, bearish short interest in technicals. Now, who actually owns the stock? Let's look at Chapter 5. Ownership structure.
All right, stakeholder analysis. Institutional ownership, meaning big funds, hedge funds, etc., it's actually relatively low, only 9.44%.
How many shares is that?
About 8.5 million shares held by roughly 55 institutions. And these aren't your standard big mutual funds. They tend to be more specialized hedge funds. Names like MMC Key, International, Susquehanna, Paragon Capital come up funds, often known for taking on higher risk, catalyst-driven positions.
And you mentioned something interesting about MMCP earlier.
Yes, this is where it gets really interesting. One of those key holders, MMCAP, significantly increased its position recently. This led to a huge jump, 184.22% in the total institutional shares held last quarter.
Wow, what could that mean?
Well, it could be seen as a leading indicator. You have sophisticated investors, presumably doing deep due diligence, deciding to place a much larger bet on the company. That's potentially a strong positive signal.
What about insider holdings? Are the execs buying?
That's the flip side. Insider holdings are minimal, only about 0.8% of the company. The CEO, Suresh Venkateswaran, owns about 0.3%, worth around $1.36 million based on the recent price.
And buying or selling activity.
This is crucial. There have been no open market purchases or sales by insiders in the last 12 months, zero.
Huh. So, expert, if management is painting this picture of being on the verge of a big commercial breakthrough, wouldn't you expect them to be buying shares hand over fist?
You often would, yes. It's a fair question. Insider buying is usually seen as a powerful signal of genuine conviction in the company's prospects, its absence here.
Well, it's a missing piece of that bullish puzzle, isn't it?
Doesn't screen confidence from the inside, does it?
It doesn't provide that strong confirmation signal, no. There
No.
could be reasons. Maybe they have enough stock options, maybe blackout periods, personal financial planning. But from an outside investor perspective, seeing zero buys isn't ideal when looking for conviction.
An overall ownership concentration.
It's highly diffuse, meaning it's spread out. The general public retail investors holds the vast majority, about 89.8%. What does that imply?
High retail ownership often contributes to higher volatility. The stock price can be more easily swayed by general market sentiment, news flow, social media buzz, things that affect individual investors more directly than institutions.
Okay, that paints a clearer picture of who's involved.
Yeah.
Let's move to Chapter 6, Risk Assessment.
All right, let's try to distill this with a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. What should you keep in mind? Strengths. Clearly, their proprietary IP, that patent portfolio, 74 plus granted, the experience management team we discussed, those key strategic partnerships with industry heavyweights like Foxconn, Luxshare, and the potentially capital-efficient fab-light model itself.
That makes sense. Weaknesses.
Pretty stark. They're pre-revenue, essentially. Significant and accelerating losses. High cash burn requiring constant financing, which leads directly to that shareholder dilution issue. And critically, they haven't yet proven they can scale this complex manufacturing process reliably and affordably at high volume. Huge execution risk there.
What about opportunities?
Massive. The addressable market AI data centers is gigantic and growing rapidly. There's the potential, if they succeed, for their tech to become a new industry standard. They could expand into related markets like 5G infrastructure or automotive LiDAR down the road. And that China Plus One strategy, diversifying into Malaysia, is a key opportunity for supply chain resilience.
And finally, threats.
Intense competition from those huge established incumbents is number one. The sheer inertia of the existing ecosystem companies are slow to change suppliers or adopt radically new tech. Macroeconomic headwinds, inflation, high interest rates hurt their valuation and make future financing harder and more expensive. And of course, geopolitical tensions, potential tariffs, trade wars, especially relevant given the semiconductor focus.
You know, it's interesting how that China Plus One strategy you mentioned under opportunities, establishing manufacturing in Malaysia, it could actually turn a threat, like a potential new tariffs on Chinese semiconductors, into a competitive advantage for POET, couldn't it?
Absolutely. As big customers get more nervous about supply chain risks and geopolitical tensions, having a diversified, partially non-Chinese manufacturing base could become a really significant selling point, a strategic advantage born from a potential threat.
Okay, let's try to wrap this all up. Chapter 7, Conclusion.
All right, synthesizing all this. Let's start with the bull case. What's the argument for POET?
Lay it out.
The core argument is that their patented optical interposer technology offers a genuinely disruptive fix for major bottlenecks in photonics, specifically cost, power, and scale. These are exactly the problems holding back even faster growth in AI and hyperscale data centers. POET positions itself right at the heart of solving that.
And then the management and partnerships add weight.
They add crucial credibility, yes. The experienced leadership and the validation from Tier 1 partners like Foxconn, Luxshare, Mitsubishi suggests the technology is real and commercially relevant. That's the optimistic view.
Okay, now the bear case. The argument against?
It's equally compelling, grounded in the harsh financial reality. This company is basically pre-revenue. It's burning through cash at an accelerating rate. And it's funding itself almost entirely by issuing new shares, constantly diluting existing owners.
Execution risk, too.
Immense execution risk. Taking this incredibly complex tech from lab R&D and prototypes to reliable, high-volume, low-cost manufacturing is a monumental challenge. Many promising technologies fail at this stage, and let's not forget they are fighting a true David and Goliath battle against competitors with vastly more resources and market power.
So back to that valuation point. That educational DCF model suggested $11.46.
Right. An estimated intrinsic value of $11.46 per share.
But we need to stress again, this is not a price target, right? It's not a prediction.
Absolutely not. It's purely an illustration of the potential value if and only if their very ambitious plan succeeds, if they execute flawlessly, and if the market widely adopts their technology. Big ifs.
So the current price, around $5.04, represents a significant discount to that potential value.
Correct. But that discount exists for a very good reason. It directly reflects the substantial, undeniable risks involved in actually achieving that potential value.
High risk, high reward then.
Precisely. An investment in POET today is absolutely a high-risk, potentially high-reward proposition. If they navigate the challenges, scale successfully, and capture significant market share, the returns could indeed be multiples of the current price. But if they fail to execute, can't secure ongoing funding, or get outcompeted, the potential for significant capital loss is just as real. It really highlights how groundbreaking innovation often walks hand in hand with substantial risk.
So what does this all really mean for you listening in? It's a powerful reminder, isn't it, that the most exciting, potentially game-changing disruptions often emerge from these smaller, ambitious players tackling giant systemic problems.
But it also shows that the path from a brilliant concept to widespread market success is never easy. It's almost always a high-stakes gamble.
So the question for you is, how do you weigh that promise of truly groundbreaking technology against the stark financial realities and those immense execution risks we've discussed? We really hope this deep dive into POET Technologies has given you a much clearer, more nuanced picture of this fascinating company. If you found this breakdown valuable, maybe consider liking this and subscribing to Stock Analytics AI.
Yeah, support helps us keep doing these.
Absolutely. Members get priority access to deep dives on tickers like this one for €4.99 a month. And big news. Over the next few months, we're actually aiming to cover all of the S&P 500 stocks, and members will get exclusive priority access to those analyses.
That's a huge undertaking.
It is. And if you just want a specific deep dive, maybe on a stock we haven't covered yet, you can always drop us a super thanks. We appreciate the support, however it comes.
And now, the important bit. Please remember, this analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice.
Definitely not. Always do your own thorough research, consider your own financial situation and risk tolerance, or consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us for this deep dive.